The discussion on financial reporting is ultimately geared towards understanding what all financial statements are we supposed to prepare. For example, the usual set of financial statements for us consists of balance sheet, that is the statement of financial position, statement of profit and loss and other comprehensive income, statement of changes in equity, statement of cash flows, significant accounting policies, and the last thing is notes to accounts. While statement of financial position and statement of profit and loss and other comprehensive income, we have learned how to do this in our prior classes in 11th and 12th. Preparation of statement of changes in equity is relatively a newer development. To throw some light on that, when I was studying to be a chartered accountant, and by that I mean I'm talking about the years 2011, 2012, back in the day, we did not have a standard that was specifically targeted, or we did not have any specific discussion on statement of changes in equity. Of course, that is a newer gift to all of us. On the other hand, preparation of cash flow statement was always a requirement, although cash flow statements became mandatory for business entities much later. As in, initially only balance sheet, P&L, notes to accounts were, considered as the complete set of financial statements. Cash flow statement came in a little later. As a it was always prepared. It was, but the compulsion happened later. Earlier, there was also something known as a fund flow statement, which basically dealt with working capital, but it isn't there so much now. The topic of this discussion today, right now, is going to be cash flow statement. Now, if you have done 11th and 12th commerce, I'm sure you had cash flow statement back then. But we are doing this discussion assuming that you have never heard of the term cash flow statement or anything related to that before. So do not worry. Even if you have forgotten about cash flow statements, I'll make sure that through this discussion, we take care of all of those aspects. Now, before we get into cash flow statements, there are a couple of terms that I would want to lay down as basic definitions. What are these? The first term that I would want to define is cash and cash equivalent. Cash, of course, is your cash in hand. See, cash flow statement. This statement basically would want to explain the reasons for differences in cash balances. So there is a cash in hand, that is, cash in my cash box. There is cash in my bank account, that is deposits repayable on demand. What do I mean by repayable on demand? Assume that I have 10 lakh rupees in a current account. I go there and I want to withdraw the entire amount. I can withdraw that right now without having to give any reason. The moment I want it, I can withdraw it. That is what is basically deposits repayable on demand. So balance in current account and fixed deposits with the bank. Mostly those fixed deposits which are in India, you have the tax saver fixed deposit. I also have made a couple of tax saver fixed deposits. What does the tax saver fixed deposit do? The tax saver fixed deposit does one very simple thing. It says we will block your money for 5 years. And when you invest money in a 5-year tax saving fixed deposit, the amount becomes blocked. You are not able to break that fixed deposit before the expiry of 5 years. So that is not a deposit repayable on demand, but a regular fixed deposit, I can break it at any point in time. So cash in hand, deposits repayable on demand, and these are, those items which are either cash or can be converted into cash in a moment, or you can use that for making payments or whatever. From that, you subtract the amount of bank overdraft. Now, what is bank overdraft? Bank overdraft is a special facility that banks provide to business individuals, businesses and companies both. What is this scheme? See, usually if I have 10 lakh rupees in my bank account, how much can I withdraw? Maximum, I can only withdraw up to 10 lakh rupees. I cannot withdraw a rupee more than that. But there are times, when business entities need quick funds, they need funds to make payments to suppliers or, for starting off a major project, and their money might be stuck with a debtor, or their money might be stuck, in stock, which, will get converted to cash only when the stock gets sold. But they have an immediate requirement for cash with them right now. So what happens in this case is that the banks give an extra facility to the business owners that you can withdraw money from the bank account over and above your current limit. Okay, you can withdraw money from your bank account over and above the current limit. So when you withdraw over the limit, you are overdrawing money from the bank account, and that facility is known as overdraft, which means if I have 10 lakh rupees deposited in my bank account, I have taken the overdraft facility on this, I can withdraw 10 lakh and then I can withdraw some more. So it's like a short-term loan that I have taken from the bank. Now, the bank does not give the overdraft facility to any Tom, Dick, and Harry. What the bank says is, we'll have a look at your financial statements. We'll see what is the position of your current assets, current liabilities, what is your liquidity position. And based on that, we will sanction you a particular limit up to which you can withdraw money from your up to which you can withdraw or overdraw money from your bank account. That facility is known as bank overdraft. So bank overdraft is a short-term borrowing that you have taken from the bank. But the thing is that this borrowing is repayable on demand. What do you mean by repayable on demand? Tomorrow, if the bank manager calls you up and says that, listen, we don't have any faith in your organization anymore, return the money to us. That becomes that becomes repayable on demand. So now you can't say, like you can say in a 5-year term loan, that I will make the repayment only as per the agreed upon schedule. Here, what I don't have the flexibility to do is, I don't have the flexibility to pay it over 3, 4, 5, 6 number of years. The moment the bank says return the money, I have to return the money. Hence, bank overdraft is a loan repayable on demand. Okay, bank overdraft is a loan repayable on demand. Now, this is a facility that has been extended. In what way? This is a facility that has been extended to only those credible businesses who have a relatively strong financial record. That facility is bank overdraft. So at any given point in time, if I want to calculate how much cash do I have, what I should do is I should add the cash in my cash box. To that, I should add the money that is there in my current account, say another 100, money that is locked in fixed deposits, which can be broken at any given point in time, minus say the amount of bank overdraft, which is 70. So this is my net cash position at the end of the year. Okay, so this total is my cash in hand, cash at bank at cash at bank in current account and fixed deposits, less the amount of bank overdraft. And let me introduce to you another term which is known as cash equivalent. What are cash equivalents? Equivalent, similar to cash but not cash. Short-term, highly liquid instruments which are readily convertible into known amounts of cash and are subject to an insignificant risk of changes in value. Now, if I'm investing in equity shares of another company, those can be converted into cash, but they face a significant risk of change in value. I could purchase shares of Reliance right now for 3,000, and because of the volatility in the market, the share price could fall by 400 rupees, and the shares would be trading at 2,600 tomorrow. So if I go to sell the shares of Reliance, I will not receive the 3,000. There is a significant risk, there is a significant chance of change in value. So these investments are usually not considered as cash equivalents. Okay, but for investments to be considered as cash equivalent, they should have a short maturity, which is usually up to 3 months. And there should be an insignificant risk of loss in value. Okay. So for an asset, for an investment to be considered as cash equivalent, they should have a short maturity, usually up to 3 months. Instruments that have a maturity longer than that are usually not considered as cash equivalents. Now, if you observe carefully, most of these securities would then turn out to be uh, your money market securities, securities in the short term market, equity shares, bonds probably don't fall under this category ever. So in cash flow statement, what we are going to do is we are going to evaluate the reasons for changes in the balance of cash and cash equivalent. Okay, so opening balance versus closing balance, the difference between these two, we would try to explain using this statement, which is the cash flow statement. And we are not explaining the reasons for difference just in cash. And for us now, cash is cash in hand, cash at bank in current account and fixed deposits, and less the amount of bank overdraft. This is cash, and then cash equivalents together is what I'm going to evaluate further. Now, the purpose of cash flow statement. This statement explains the reasons behind the changes in balance of cash and cash equivalents. If the opening balance of cash and cash equivalents is 10,000 and the closing balance is 15,000, the cash flow statement outlines the reasons for this movement in cash balance. So if my opening balance is 10, closing balance is 8, that means my overall cash balance has reduced by 2,000. What are the reasons for this change? And the cash flow statement classifies these reasons into three categories. Is it because of my regular business operations, that is, or my routine business activity, that comes under cash flow from operating activity? How much of the movement in cash balance is because of my regular day-to-day routine business operations? Or how much of the movement in my cash balance is on account of purchase of new non-current asset or disposal of old non-current asset? That is my investing activity. How much of a change is happening because of capital commitment? Investment activity is primarily talking about capital commitments. And what are capital commitments? Capital commitments are those items which are basically long term in nature, and those items which primarily lead to purchase of a non-current asset or disposal of a non-current asset, including investments. The third activity which could bring about a change in cash and cash equivalents is the act of financing. If I am raising funds for my business in the form of a loan, by way of issue of equity shares, by way of issue of preference shares, or if I am repaying the amount of loan, or I am paying dividend to the shareholders, all of these are financing activities. So any activity that basically leads to generation or usage of cash falls into one of the three categories. Which three categories? A, operating activity; B, investing activity, which is basically purchase and sale of non-current assets; and then financing activity. Financing activity is the act of raising funds for the business to run the operations or the repayment of such funds. Both of these come under the category of financing activity. So the reasons for movement in cash and cash equivalents are three: operating activity, day-to-day business operations; investing activity, purchase and sale of non-current assets including investments; and financing activity, that is due to raising money or funds for running the business and repayment of such funds. Okay, now that we have understood why we are preparing the cash flow statement, to analyze the reasons for difference in the opening and closing balance of cash and cash equivalents, now we'll go further into understanding each of these components in great detail. Let's start with operating activity. Operating activity or operations are my day-to-day routine activities of the business. So all the cash inflows that you get from routine activities and all the cash outflows that happen because of your routine activities are basically cash flow from operating activity. Now, if I talk about routine activities and inflow, say I am a tutor and I coach students for different professional exams. What is my main business activity? My main business activity is teaching. And what do I get? I get cash from my teaching activity. That is my operating activity inflow. And I have to make payment of internet charges. And without the internet charges, I will not be able to conduct my classes at all. So that is a cash outflow for my day-to-day operations. That is a cash outflow under operating activity. If I have taken a premises on rent from where I conduct my coaching, then that premises ka rent is also my Outflow for day-to-day operations, that is also cash flow from investing activity. If I'm paying salary to my staff members for carrying out the main business, that is also cash flow from operating activity. Regular expenses paid, tax paid, cash collected from the students immediately before start of the batch is cash inflow under operating activity. And if there are certain students who say, sir, we'll join the batch right now, but we'll pay your fees a little later, that is also cash flow from operating activity, basically cash collected from debtors. So when I talk about operating activity, these are basically cash inflows and outflows that are associated with day-to-day running of the business. Any cash inflows and outflows that are associated with the day-to-day running of the business are covered under operating activity. The second type of the second source of generation or usage of cash is investing activity. And what all is covered under investing activity? Basically covers those transactions which deal with purchase and sale of non-current assets, including investments and their associated cash flows. What do you mean by associated cash flows? Suppose I invest in a 5-year gold bond or a 5-year bond issued by the Reserve Bank of India. That is an outflow for making an investment. And on that, if I am receiving any interest, then that is my associated cash flow. So what all comes under investing activity? Basically, you are talking about the non-current assets here. If you purchase a new machine, plant, equipment, property, that is purchase of non-current asset. And if you sell these items, the proceeds from the sale of these non-current assets is also a cash inflow under investing activity. If you have paid cash to purchase shares of another company, if you have received dividend on these shares, if you have sold the shares that you have purchased, all of these again are cash flows under investing activity. Same thing goes for bonds. If you pay money to purchase bonds of another company, then that is investing activity. If you sell the bonds and you receive money, that is also inflow under investing activity. So basically, whenever you purchase any non-current asset, property, plant and equipment, intangible, investment property, shares, bonds, debentures, when you invest money in any of these, that is an outflow under investing activity. When you receive money on each of these, that is cash inflow under investing activity. So all of these are non-current asset related cash flows. And you also have cash flow from financing activity. The act of financing basically means raising money for running the business. So if I take a bank loan, that is a financing activity. I pay interest on the bank loan or I repay the bank loan, that is also a financing activity. If I raise money by way of shares, then the money received on issue of shares is in financing activity. If I buy back the shares, that is an outflow under in financing activity. If I pay dividend to my shareholders, that is also an outflow under financing activity. Whenever you are raising money for running the business, that activity comes under financing activity. Technically, if borrowing money by way of loan is a cash inflow under financing activity, then ideally, see, associated cash flows will also go here. If you have raised money by way of equity shares, that is inflow under financing activity. If you pay dividend on these equity shares, that is outflow under financing activity. If we take the same logic, then I borrow a loan, that is inflow under financing activity, and I pay interest on that loan, that should ideally be outflow under financing activity. But IAS 7 cash flow statement gives you a choice here. It specifically says that interest paid can be shown under operating activity also, or it can be shown under financing activity also. So there is no problem per se wherever you show, but our ACCA study material, our IFRS study material basically expects us to show interest paid as an outflow under operating activity. Okay, so this is one thing you have to keep in mind. There are two options, financing or operating, but ACCA expects you to show interest payment as outflow under operating activity. Okay, this is one thing that you have to keep in mind. This might contradict the basic matching principle that you are applying here, that if I raise money by way of equity shares and I raise money by way of equity shares, that is financing activity inflow, and then I pay dividend, that is the financing activity outflow. Same logic should apply to interest, that if I raise money by way of a loan, that is financing activity inflow. So interest paid on that loan should also be a financing activity outflow. But IAS 7 gives you a policy choice. Show it under financing activity or show it under operating activity. Our study material throughout shows it as an outflow under operating activity. So that is what we are also going to follow. Okay. Now we will be looking at a couple of, before going to, attempt the full length questions, I would want us to have a look at individual activities to understand how is cash flow calculated from investing, how is cash flow calculated from financing, so on and so forth. We'll do all of that so that the basic concepts become clear, and when we do a full-fledged full length question, we know exactly how to deal with it. Okay, so let's start with the investing activity calculations. Have a look at this question or this basic data. How to calculate, this is basically an illustration of how to calculate cash flow from investing activity. We are not looking at any other aspect of the financial statement. We are only looking at investing activity. Aditya Limited is a company, with the following transactions. Purchase of a new laptop for head office, 45,000. Investment done in shares of TCS Limited, 90,000. Dividend received on shares of ITC, 9,000. Dividend paid, 10,000. The company also had the following balances for plant and machinery. Cost, accumulated depreciation, and the carrying amount is given. During the year, an item of plant and machinery was disposed of. The plant sold had an original cost of 80,000 and an accumulated depreciation on the plant sold was 15,000. The loss on disposal of plant was 5,000. You have to calculate cash flow from investing activity. Purchase of a new laptop for head office is an outflow very clearly. You don't really need to think too much. 45,000 is an outflow. Show it that way. Investment done in shares of TCS, you are purchasing shares of another company. So that is also an outflow. You had invested in the shares of ITC Limited and you received a dividend of 9,000 on that investment. So when you purchased shares of ITC, that must have been an outflow under investing activity. So the associated cash flow of dividend is also under investing activity, but it is an inflow. And dividend paid 10,000. When exactly do you pay dividend? You pay dividend on the equity shares that you have raised. And equity, raising money by way of equity shares is a financing activity. So dividend paid will not come here under investing activity. This will go under financing activity. Okay, now pay attention to this. The company also had the following balances for plant and machinery, cost, accumulated depreciation. So prepare a plant account. Plant, that is my plant and machinery. That is my non-current asset account. Then I need to create my accumulated depreciation account. Okay. Plant. So because accumulated depreciation account is maintained, that naturally means that the plant or the non-current asset is at cost. So opening balance is 7,50,000. Opening debit balance on the debit side. To balance brought forward how much? 7,50,000. Closing debit balance on the credit side by balance carried forward. How much? 10,48,000. Accumulated depreciation has a credit balance. It is in a lot of ways the contra of the plant and machinery account. Opposite. Contra is opposite of this account. Accumulated depreciation, opening balance 1,20,000, opening credit balance on the credit side, buy balance brought forward 1,20,000, and closing accumulated depreciation is 1,90,000. So to balance carried forward 1,90,000. Closing credit balance on the debit side. During the year, an item of plant and machinery was disposed of. The plant sold had an original cost of 80,000 and accumulated depreciation on the plant sold was 15. The loss on disposal of plant was 5,000. Now I want you to have a look at some information. Okay. What is the cost of assets sold? 80,000. Okay. Accumulated depreciation on assets sold 15,000. So what is the carrying amount of asset? The carrying amount of assets sold is cost minus accumulated depreciation till date, which is 65. And the question says that the loss on disposal was 5,000. So an asset whose carrying amount was 65,000 was sold at a loss of 5,000. So if an asset with a carrying amount of 65,000 asset has been sold at a loss of 5,000. So what must be the disposal proceeds? Asset जिसका carrying amount 65,000 था was sold at a loss of 5,000. So disposal proceeds must be 65 minus 5, that is 60,000. Now, whenever you have a situation like this, that the cost is given and the accumulated depreciation is given, then instead of mixing everything up in one place, what we prefer doing is we open a separate account called as the asset disposal account. Okay. This is a temporary account which is opened only for the assets that are sold. Now, what is the cost of because we don't want to mix everything up in one place. We are just separating out the sale transaction. What is the cost of the asset sold? The cost of the asset sold is 80,000. Okay, and this asset is already included here in this 7,50,000. This 80,000 is included. Now we want to separate it out. Okay, how will I remove a particular balance from the non-current asset account? I will credit it. So my entry will be asset disposal account debit to non-current asset account. Okay. So through this entry, what I have done is I have transferred the cost of the asset sold to a separate account known as the asset disposal account. Now there is and on this particular plant and machinery, what is the accumulated depreciation till date? 15,000. Accumulated depreciation 15,000 must be a part of this. I want to remove it from accumulated depreciation and put it in another account. What is the accumulated depreciation as a credit balance? This 120 contains the 15. I have to make sure that जो asset sell हुआ, the asset that was sold, all balances relating to that asset are transferred in one place, which is my asset disposal account. So to asset disposal 15,000, and here by accumulated depreciation 15,000. How does this help me? Now, if you observe, the cost of the asset sold and the accumulated depreciation on the asset sold is sitting face to face in one account. Now, you can clearly see that the carrying amount of the asset sold is 80 minus 15, that is 65. This asset was sold for 60,000. What is the accounting entry? The accounting entry is by bank account debit. How much? 60,000 by loss on disposal account debit 5,000, and the asset that is sold, it is not sitting in the non-current asset account. The balance on the asset sold is sitting in the asset disposal account. So bank account debit, loss on disposal account debit to asset disposal account. How much is the balance? The balance is 65,000. Okay. So how does this help me? This helps me to know the accounting entry. Here I will write down by loss on disposal 5,000, by bank 60,000. This is my cash inflow. So maybe, I want to highlight this in a different color, in a new color, so that I know how much is the amount of cash inflow. And that's it. That's pretty much it. That's all I had to do. I had to calculate my cash received on the disposal of the asset. Now observe one more thing. What is that? Now, in case of this plant and machinery, this account has not been closed, right? So I'll have to close this particular account as well. And when I do that, I will get the cash paid for purchase of new asset. So this balancing figure would mean new asset has been purchased. How much would be the balance? The balance would be 3,78,000. This is my balancing figure. Okay, so this is my balancing figure. This is cash paid for purchase of new plant. Okay, purchase of new machinery minus 3,78,000. Disposal proceeds of the old machine 60,000. And with this information put together, I finally have my cash flow from investing activity. So in your cash flow statement, this is the investing activity part. Now, in your whichever exam you are writing, whether you are writing the strategic business reporting exam of ACCA or you are writing the diploma IFRS exam, preparation of cash flow statement by itself is not tested. But you should know the format, and the knowledge that you are gaining here is going to be super helpful when you sit down to prepare consolidated cash flow statement, which is a part of your exam. So to do consolidated cash flow statement properly, you should first of all know how is a standalone cash flow statement prepared, which is why we are spending time on developing this aspect. Now, let's have a look at another one, which is basically cash flow from financing activity. Okay, have a look at this. Navdeep Limited had the following transactions for the year ended 31st of December 2024. Issued 1 lakh ordinary shares of face value 10 for a price of 25. That means these shares were issued at a premium. Raised 8 lakhs by way of debentures. Paid dividend of 1,50,000. You pay dividend on equity shares, and raising money by way of equity shares is a financing activity. So when you pay dividend on those equity shares, that is also a financing activity. Paid interest on debentures 56,000 and repaid an existing loan of 2 lakh. So now they want you to calculate the amount of cash flow from financing activity. Let's start. Cash flow from financing activity. Let's go line by line. When you issued 1 lakh equity shares, and you issued one share at a price of 25 and 10 rupees was the face value, how much money did you receive in your bank account? By bank account debit, 1 lakh into 25. To share capital account, 1 lakh into 10. To share premium account, amount received over and above the face value is your share premium. How much share premium did you get? You got a 15 lakh share premium, and this becomes your accounting entry. Bank account debit to equity share capital to share premium. Okay. So I should write down proceeds from issue of equity shares. How much? 25 lakh. Raised 8 lakh by way of debentures. So cash raised by way of debentures is also, or loan notes is also a financing activity. So proceeds from issue of debentures 8 lakh. Then dividend payment of 1,50,000 is an outflow. See, when you raised money by way of equity shares, that was an inflow under financing activity. When on the same shares you are paying dividend, that will be an outflow under financing activity. Repaid interest on debentures. Now the point is any interest that you pay on borrowed funds ideally should be classified as an outflow under financing activity. But IAS 7 gives you that flexibility, and it gives you an option that you could either show it as an outflow under financing activity or you could show it as an outflow under operating activity. But as I gave you in a note already, any such cash that is paid for interest according to our ACCA syllabus, IFRS syllabus, it has to be shown as an outflow under operating activity. So then you should do it. You should do what the study material tells you to do. So don't consider it here. And of course, repayment of existing loan. How much is the repayment of an existing loan? 2 lakh. So what is 29 lakh 50,000? That is cash flow from financing activity. So we understood through an illustration how to arrive at the value of cash flow under investing activity. We also understood how to arrive at the value of cash flow from financing activity. Now, what we have is we have cash flow from operating activity. This is, I wouldn't say it's tricky, but I would definitely say it requires a little more of your attention. So please focus here. Now, when it comes to what are operating activities, these are my day-to-day activities of the business, correct? Cash flow from operating activity is basically cash flow from the day-to-day activities of the business. What I do on a routine, regular basis from those main business activity, whatever cash flow I am generating, that will be written here. Now, when we talk about cash flow from operating activity, there are two methods of presentation. The first method is known as the direct method, and the second one is the indirect method. And there's a good enough reason for calling it this way. If I were to ask you, I have a class of say 50 students. Okay, there are 50 students in my class, and I ask you how many boys, and you sit down and you count the boys 1, 2, 3, 4, 5, 6, 7, 8. You count the boys that way. That is direct activity. I ask you the number of boys, you count the number of boys. Then I ask you, tell me the number of boys. What you do is you take the total number of students in class, and from that you subtract people who are not boys. That is, you subtract the number of girls. What you are left with is the number of boys. So first method, direct, count the number of boys and you have the answer to my question. Second method, I ask you, tell me how many boys in the class. What you will do is from total 50, you take the total, and from that you remove the number of people who are not boys. That is, you remove the number of girls, and the number left with you is the number of boys. The second method is known as the indirect method. The first method is known as the direct method. I ask you number of boys, you count the number of boys and you tell me. I ask you number of boys, you take the total number of students, and from that you remove the number of people who are not boys, that is girls. People left with you are the number of boys. This is your indirect method. Instead of eating like this, you do a whole round and you eat like this. That is the indirect method. Direct method is मैंने जो पूछा उसका आंसर दिया. Indirect method, you went in a roundabout fashion and you got the answer. That is how the indirect method of indirect method works. If I ask you under operating activity, tell me how much cash did you get from main business activity? You will just take all the cash inflows and outflows from the main business activity. You will do plus minus and you will tell me the answer, which is exactly what we are going to do here. Indirect method, I will explain that separately. Under the direct method, cash flow is calculated by considering cash collections and cash payments in the ordinary course of business. That is in the case of day-to-day activity. Now think about a business entity. In its ordinary course of business, in the course of its regular business operations, what all avenues for generation of cash exist? The first one is cash generated from cash sales. Second one is cash collected from debtors. That would be the main business activity. And all the other expenses, payment of salary, payment of rent, payment of purchase cost of raw material, payment to contractors, all of that would be outflow in the ordinary course of business, outflow as a part of your day-to-day business activity. And that those would be cash outflows under operating activity. Question is, what cash flows do you have on a day-to-day basis? Cash inflow from cash sale, cash inflow by way of collection from customers, debtors, and cash outflows, payment of cost of raw material, payment of wages, payment of salary. कैश कहां से आया, कैश कहां पे स्पेंड हुआ, इसका आउटकम इज योर cash flow from operating activity under the direct method. Why is it called direct method? Because I'm directly calculating cash inflows and outflows. I asked you cash, you are calculating the cash inflows, outflows. You are not going about it in a roundabout fashion. That is what is the direct method. Now have a look at the requirements of this. Have a look at what is given in this question. Okay. Navdeep has the following data. What data does Navdeep have? Debtors, creditors, salary outstanding, prepaid rent, credit sale, credit purchase, cash purchase, salary expense and rent expense. Okay. The first thing that we should do is create a debtors account. Debtors have an opening balance of 67,000. To balance brought forward, opening balance of 25. How debtors have a debit balance, opening debit balance on debit side, closing debit balance on the credit side by balance carried forward. How much? 67,000. ठीक है. Credit sales are 2,40,000. What is the accounting entry for credit sales? Debtors to sales. So debtors to sales, how much? 2,40,000. Now there has been no other information in the question about debtors. Okay, just leave the account like this. Make sure that you are putting a tick mark for all the balances and transactions posted. You posted this and you posted, sorry, the credit sales figure. Then creditors, let's prepare a creditors account. Creditors have a credit balance, opening credit balance on the credit side by balance brought forward 36,000. Closing credit balance on the debit side to balance carried forward how much? 42,000. Okay. And credit purchases. What is the accounting entry for credit purchases? Purchase account debit to creditors. So here on the credit side, please write down by purchase account. How much? Credit purchases 1,56,000. Okay. Now, salary outstanding. Salary outstanding is a current liability. It is an amount payable. So salary outstanding account will also have a credit balance. Opening credit balance on the credit side by balance brought forward. How much? 12,000. Closing credit balance on the debit side to balance carried forward 20,000. Salary expense for the year. Now, salary expense means this is the amount of expense that has gone to P&L. That means the transfer entry at the end of the year must have happened with this account. What would be the transfer entry? P&L account debit to salary. So, यहाँ पे I would have by profit and loss. How much? 1 lakh. This is posted. And then there is rent. So, rent account or rent prepaid account or whatever you want to call it. Now in this account, what do you have? You have an opening debit balance of 4,000. Opening debit balance on the debit side to balance brought forward 4,000. Prepaid rent, closing debit balance on the credit side 5,000, and rent expense during the year is 60,000. When I say rent expense during the year is 60,000, what I mean is that the amount of rent in P&L, expense in P&L is 60,000. That means the transfer entry at the year end must have happened with this value. How does the transfer entry work to that effect? P&L account debit to rent account. So here I'll have by profit and loss 60,000. I have not yet closed any of the accounts, but I have definitely given effect to all the balances and entries. Now let's try to close each of these accounts. Okay, opening balance of debtors 25, new credit sale 2,40,000, closing balance 67. What is my balancing figure? My balancing figure is 1,90,000. This would be cash collected from debtors. Okay. Use This is cash collected from debtors. So in the cash flow statement, cash collected from debtors, this is cash collected in the course of main business activity, include it. Then cash sales 89,000. Cash collected from cash sales 89,000. No adjustment, nothing required. This is also taken care of. Okay, then cash paid to creditors. You have a creditor account. You have an opening balance of 36, new purchases of 156. Okay, and you still have a closing balance of 42,000. That means the remaining amount has been paid to the creditors. How much has been paid to the creditors? 1,50,000 has been paid to the creditors. This is my cash payment to creditors. Show it with a negative sign, minus 1,50,000. Cash purchases 45,000. Salary outstanding. From this, I had opening outstanding of 12. I had further expense of 1 lakh, and 20,000 is still outstanding. So what is the what is the amount that must have been paid? I must have paid 92,000. So to bank. Salary paid minus 92,000. So we are closing the accounts ledgers one by one, something that we used to do in 11th and 12th standard also. Then rent paid. Opening 4,000, closing 5,000, and expense during the year 60,000. The balancing figure here would be 61,000. Okay, so this is my rent paid. After doing this, what I will have is I will have a complete picture of all the cash inflows that happen during the course of my regular business activities and all the cash outflows that happen during the course of my regular day-to-day business activities, and the net impact is 61,000. What is this 61,000? 61,000 is basically cash flow from your regular operating activity. And the reason why we call it the direct method is when asked about the cash flows, we straight away process the data about cash inflows and outflows. We did not go about this in an indirect or a circular manner. We straight away attacked the data to get the desired answer. This method of calculating cash flows under operating activity is called the direct method. The next method that we are going to study is cash flow from operating activity, but using the indirect method.